Everyone, welcome back to Yuri's Box. In this video, I'll be talking about the latest economic data and how that relates to TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I'm back with the sniffles. So if you hear my voice a little bit, smoky, you know why. Let's jump right into it. So we started off the week with the final read on S&P PMI manufacturing index. And again, I'm not going to waste too much time on it because, again, it's basically a complete repetition of what was highlighted in the preliminary report earlier in May. And again, the main theme, again, is this walk back in tariff policies that has served to boost the outlook in the business community. All right. Well, yes, you do have, as highlighted in green, new orders continue to increase. Mostly that came as, a consequence of stabilization in trade policies that ensured confidence in the outlook improved. And while a rise in employment was registered, it was marginal. Okay. Again, looking at the comments here, which I think was probably the most interesting part of this final report. The rise in the PMI during May masks some worrying developments. And you can follow, you see some more follow through on that further down below. Encouragingly, manufacturers regained some optimism in May after sentiment had been hit hard by tariff announcements in April. However, uncertainty clearly remains elevated. Again, yes, we go from total trade embargo to something that is definitely more manageable, like 30% tariffs. And again, I stress 30% tariffs are not good news. All right, they're bad news, very, very bad news. But again, when compared to decoupling, everything looks great. All right, so that definitely helped boost things. Sentiment, a sigh of relief, as I've been saying. But at the same time, does it allow you to take huge decisions, make huge bets, huge investments? No. Why would you make huge investments in such an environment where the framework changes from week to week? No, forget from week to week, on the weekend, all right, in a couple of days. So this isn't a supportive framework for businesses to thrive in. All right, they might be able to hold up. Again, I'm not calling for a collapse. I've never have been calling for a collapse. Again, I've been saying this is a process and things will have to, we'll have to work through it rather than seeing spike. But again, it is what it is. All right, it's difficult for businesses to make huge decisions. All right. Now, when talking about the week ahead last week, it was easy to point to non-farm payrolls, being the most important data set of the week. All right, consensus is at 130. The unemployment rate is at 4.2, expected to come in. All right, but we also have a few other data points. All right, before we move on to the ADP that just came out, JOLTs report, the level of job openings slightly elevated, right, compared to expectations. We were basically at 7.1, all right, give or take. We came in at basically 7.4. Now, again, disclaimer, every time we see the level of job openings be a little bit better than expected, we see the narrative come back that it's a red hot economy, red hot economy, red hot economy. And we've seen it throughout this cycle, right? It bottoms out, it bobs around the same level, and it's a red hot economy. Then it goes back down, then it bottoms out. It bobs around the same level it bottomed out at red hot economy, then it keeps on going down, and you get the picture. All right, and while I haven't really read, I can't say that I've read people use this data to say that it's a red hot economy. at the very least, you have seen, some spins that, oh, it's good, we were expecting Armageddon, and yet we see job openings increase, right? Again, I wouldn't, be too excited about this read, because again, what this data set has shown us is that it likes to do exactly this. If you look at 2023, it bottomed out at 8.6. And, before it decisively broke down, it was March of 2024. All right. That's 6-7 months. How much is that? Same thing right here in August of 22. It bottomed out in August of 2022. And before we saw a significant breakdown in job openings, it was February 23. All right. So what I'd say in the job openings is look at the direction rather than, these small bobs. All right. And again, one of the ways you could think about job openings is put them in relation to, for example, continuing claims. All right. And why is that? Because, the basic idea is that as the level of job openings decreases, it becomes harder to find a job if you lose your job. Hence, as job openings decline, you should see continuing claims increase. Or rather than you should see continuing claims increase, it just adds a tailwind to continuing claims to increase. All right, that's one way you could think about it. My favorite part of the JOLTs report is, of course, the quits rate, and we did see a decrease. All right, we're back at 2%. The low for this cycle was 1.9. We're back at 2%, and for me, nothing really has changed as far as what the quits rate is telling us. How do I use the quits rate? Again, it is basically the best kind of survey I could possibly ask for. And it is the reason, and is what I look for in, when I try to determine the state of the consumer, right? Why wouldn't I use the University of Michigan Consumer Survey or the Conference Board Consumer Survey? Because as I say many times, when you ask for people's opinions, they can easily be skewed by political beliefs. All right. If you look at inflation expectations, Democrats have been expecting Weimar Germany ever since Trump got elected. And ever since Trump got elected, Republicans have been expecting sound money economics. All right. And when Biden was in office, Democrats, everything was hunky-dory for them. And everything was, basically North Korea for the Republicans. So I tend to ignore, all right, the consumer surveys, and I try to focus more on the quits rate, because the quits rate isn't a survey of people's opinions. It's a survey of people's actions. If people are leaving their job, that tells you that they see abundance in the economy, right? If they see abundance in the economy, they are more likely to take risks. Because, simply put, if they see abundance, they can use that as leverage to negotiate a higher wage with their current employer, or leave their current job outright and go for a higher raise. Right? So again, whenever the quits rate is going up and is at cycle highs, you can expect that to be an employee's labor market, where the employee has the leverage, and as a consequence, you can expect wages to go up. You can see wage pressures increase to the upside. The opposite is true when the quits rate is at cycle lows. When the quits rate is at cycle lows, you can expect that to be an employer's labor market, meaning employees are losing leverage in the labor market, and therefore wages are likely to stay a little bit more sluggish compared to up here. All right, and again, we're at 2%. Still at the cycle lows. Things haven't changed ever since I started making videos. That was right here in February. We're at 2%. It ticked up at 2.1. We're back at 2. Nothing's changed. The my base case hasn't changed. Still the same, right? We're in a slowing economy, and everything that entails. All right, I don't want to. Let's keep it. Let's keep it going here. We have a lot to go through. So that does it for the JOLTs report. We also had a read on factory orders. Worse than expected across the board. Ex transportation. I'm guessing if I'm going off by heart here. Ex transportation is so that we avoid any Boeing shenanigans, and that was basically a miss as well. What else did we get? Of course, ISM. All right, ISM report. Now, again, the way the index is measured is slightly different compared to the S&P PMIs. In the case of the S&P PMIs, anything above 50 is expansionary. Anything below 50 is contractionary. In the case of ISM, I'm not mistaken, it was 42.3. All right, anything above 42.3 generally indicates expansion of the overall economy. All right, so again, 48.5 still relatively okay as a read, but again, as I've been saying for all the previous reports, if you just look at the index read, the number, things don't look that bad. But if you actually open the report and read them, I mean, it's a whole can of worms. It's been like that ever since really February. All right, I have been reading the reports here before I started making videos, but again, I kind of see this demarcation line between pre-February and post-February. All right. Moving on to this report in particular, new orders and backlogs contracting. That is not supportive for the outlook, right? Production and employment contracting. And again, I won't waste too much time on this because again, it is in essence a continuation of everything that we've been reading in all of these reports so far. The outlook continues to be mixed. Some good news in relation to tariff policy has definitely boosted, at the very least, sentiment in the month of May. But again, the outlook continues to be murky because everything changes week to week. And that's basically it. All right. Demand indicators were mixed. Regarding output, production index increased from an alarmingly low reading from the previous month. Factory output continued to contract in May. Employment index ticked up for a second consecutive month, but remained in contraction. All right. And what respondents are saying, I think that this first part right here, if I'm not mistaken, is quite interesting. There is continued softening of demand in the commercial vehicle market, primarily related to higher prices and economic uncertainty. The impact of ever-changing trade policies of the current administration has wreaked havoc on suppliers' ability to react and remain profitable. All right. It all comes back to everything that we've been highlighting so far. All right. Yes, trade policy has gotten better. Absolutely. We don't have a decoupling. We don't have 150% tariffs on China. But 30% is still a huge deal, especially when it keeps on changing week to week. All right. It's 30%, then, a reporter calls Trump a chicken. He retaliates on, 50% tariffs on steel. It's difficult for a business to make huge decisions in such an environment. All right. Now, I reiterate at the same time, I am not in the camp that we will see a spike. I've been saying that since April, since Liberation Day. I'm not in the camp that we will see, just things fall off a cliff. Maybe we will, but that is not my base case. If I had to paint, what my base case looks like, and I've had in my previous videos, just to give some context here, I would expect a repeat of last year. where you see kind of that growth scare, percolate throughout the summer, and as opposed to last year, we get to September, October, November, where we don't really have all of those transitory events, if you will, that made the economy look better. And so at that point, I expect it to be kind of checkpoint number 2, where checkpoint number 1 is the summer, potentially if we get the growth scare during the summer. But then that will have to translate into something more from September onwards. Okay, that's kind of how I'm going about things. I'm not expecting a just imminent collapse. All right, and I think that this is kind of what we continue to see in these reports. Right, still contracting. Still coming lower, coming in lower, coming in lower. Or you can look at all these. I'll leave this here for a minute so you can go through the numbers yourself. This is all that we've been getting. Slightly lower reads, slightly lower reads, slightly lower reads. Right, this is basically it. Employment, basically stable. New orders, basically stable, but still contracting. What's important, actually, now that I was about to forget, was prices. Again, prices, everybody was expecting huge increases on the prices index of the ISM report. But really, we got a slight decline. Now, again, I wouldn't extrapolate too much out of this because, again, it's just one data point. In order to make, some serious assumptions, you need more than 1 month. All right, so keep that in mind. And today is Wednesday, so we'll be getting another read on ISM on the services side of things for the month of May. And I'll be going over that tomorrow. I'll be making a video on initial jobless claims and the ISM report just before Friday. So that will be a topic for another video. But we did get ADP, and we got 37,000. Now again, I'll make the usual disclaimer that I always make when I talk about ADP. Take this with a grain of salt, as it has little to no correlation to what you see on Friday. Depending on how ADP comes out, bears and bulls will either discard it entirely or make it, the smoking gun, if you will. So if ADP comes in lower, as it did right now, you'll hear the doomsdayers say it's the end of the world. I've been telling you it's right. I'm right. Everything's going down the tubes. If ADP comes above expectations, bulls will take it and say, oh, I told you everything is strong and resilient, yada, 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 no recession, no recession, no recession. This is anecdotal data. That is the way I treat it. And again, ADP basically manages payrolls for, a fraction of US businesses. So it isn't a reflection of the entirety. Now, I'm not saying that the BLS number is a reflection of that, of the entirety of the business community in the US. For that, you'd have to wait for the QCEW number that gets released basically 2 or 3 quarters after. I don't remember quite well, but you get the picture. Don't read too much into this. All right, it's like Trueflation on X if you follow it, which you should. All right, but Trueflation has been indicating that inflation is being at 1.5%, and throughout this decline, we've seen over the course of the past years, we've seen deflationistas point to Trueflation and say, you see, this is the real inflation number. This is it. Now, ever since Liberation Day, Trueflation has been pointing to inflation going up. And again, now the inflationistas are saying, yeah, this is the right number. Inflation is going to tick up. Try to remain objective. Try not to fall into, these maximalist approaches where you discard data depending on if it confirms or disregards your bias. All right, try to remain objective. Having said that, having said this huge preamble to it, we can finally read the ADP number and the report. The pace of hiring in May reached its lowest level since March of 2023. As Neela Richardson puts it, chief economist at ADP, after a strong start to the year, hiring is losing momentum. Pay growth, however, was little changed in May, holding at robust levels for both job stays and job changes. And you can see the way, it was kind of divided. The change by establishment size. Basically, this is where you saw the gains really. The rest is nothing too impressive, as you can see. And most of all of the job gains came in services. You see information, financial activities, leisure and hospitality, other services. So again, try not to read too much into this report, just because in this case it confirms my personal bias that this report was going to be weak. All right, it does confirm my bias that again this report was going to be weak, but I'm going to wait for Friday's number, right? Knowing full well that even if whatever number we get on Friday, it's going to be revised lower in the coming months, all right? But again, that is what the markets will trade on, and so that's what we have to pay attention to, all right? Now, I'm fairly certain I'm not forgetting anything. I have my flu to blame if I am missing anything. And having said that, we can move on to TLT and how that relates to TLT. Now, we are having quite a significant pop after that ADP number, all right? And usually you wouldn't see this pop after ADP. I'm suspecting you seeing, a 6 basis point rally on the long end simply because it was a horrible report. I mean, 37K is stall speed. I mean, you're just a whisker away from zero and negative payrolls. It's bad. To me, anything below 50 is, again, bad. All right, so this is not a good report. If it had been, slightly higher, potentially around 90 to 85 and 95, I don't think we would have gotten this kind of a pop in TLT. But regardless, this is what we have. As far as the short term is concerned on TLT, prior to this number, we didn't really see much action on TLT. The ISM report, while being negative, wasn't outright negative. It wasn't complete. It wasn't a complete travesty. Same thing goes for the PMI report. It wasn't positive, but it wasn't outright negative. So TLT didn't really have much of a reason to, do anything dramatic. All right. On the other hand, today we have ADP, which was outright negative, and so TLT is having, its 15 minutes of fame. By the time it's the market closed, TLT probably has reversed because Trump said something and we're up 6 basis points. Who knows? That's how TLT has been going as of late. So definitely don't take that off the table. But just looking at the chart, what is interesting to me is, again, we had this trend line that was in place ever since Friday, April 4th, confirmed at the end of April, bounced off of it again in the middle of May, and at the end of May, 27th of May, we broke out of that. Looked like we were going back up, but no, we retested the trend line. And again, this isn't news. If you've been watching my previous videos, you'll know we were in a similar situation back here. Pretty sure this is it right here. All right. Where we bounced off. We couldn't really break out right here, but eventually we did. And we back tested it back in April eventually, right? This is what TLT does. It bounces off of a trend line, it breaks out, and then it back tests it. This is exactly what we've been seeing, in my opinion, in these couple of days. Second, continue to keep an eye on this, the RSI read on the weekly time frame. When comparing the January 6 low to May 19th, the May 19th low, you have, what looks like a bullish divergence with the RSI. Right, so you have lower price but higher RSI read. That is something to pay attention to. What will determine, as I said before, what will determine whether or not this divergence is something to put your hopes on is Friday's number. If Friday's number is a miss, as ADP is potentially pointing to, then absolutely expect a huge candle up, potentially to backtest the bull market support band. All right. If, on the other hand, the report is complete, as we've highlighted in my previous video, anything, case 1 and 2, so stagflation or run it hot, I would expect that to be bad for bonds. Excuse me again. And that would actually add fuel to a potential sweep of the previous low. Again, we are in an interesting position right here because this low right here still has the potential to be, the secondary low we're looking for, like it was in January of 2011. TLT likes to put in double bottoms. It's either a sweep of the previous low like in 06 and 07, or a slightly higher low compared to the previous low like in 2010 and 2011. If we get a horrible report, like potentially ADP is hinting at, but again, don't put too much faith on that, then yes, this low, the low of May 19th, could be the secondary low we've been looking for, as OB1 reported. If, on the other hand, it's case 1 or 2, look for this. All right. Which would put us, again, on the 30-year, somewhere around, 5.2 and 5.5. All right. That would be capitulation at that point. Again, you do have some clues for the moment that potentially we don't have to go that far, but it will depend on the data. If the data is bad, TLT can run. If the data is good, you know where it's going. All right. I'll keep this video short. Again, I remind everyone, just for giggles, I come up with my forecasts each month for the Nonfarm Payroll report. I currently have my expectations for the NFP number at 80K, more or less, and the unemployment rate to come at 4.3, given where initial jobless claims have printed over the course of the last few weeks. I do have, I wouldn't be surprised to see a 0.2% increase on the unemployment rate, but this is banking on labor force participation rate. If you see the labor force participation rate increase to 62.7 in this upcoming report, don't be surprised if we see 4.4 on the unemployment rate. But without this, I see 4.4 as a little bit complicated, all right? Just to summarize on TLT, and I'm pretty sure I mentioned this on Friday. The way I even during this week, the data that got released this week, to me continues to remind me of what we saw during the month of July of last year. I mean, the data was kind of murky, right? We have also had ISM and PMIs not great. We had initial jobless claims up and around 230, 235, 240. And we also had ADP miss. All right. I'm just looking at what happened last year. All right. From April to really July, up until the Nonfarm Payroll report, we didn't really see much in the price action for TLT. All right. It was pretty benign. Yeah, well, yes, we went from 87 to 93, Everybody is probably dreaming of seeing 93 on TLT again. But again, it wasn't anything dramatic. When was it that we got something dramatic out of TLT? The week of July 29th, when the non-farm payroll came out. We had the growth scare, we had the yen carry trade shenanigans. That's when TLT started to shine. Look for bad data. That is the only reason why you would want to own TLT. If you think that data is going to come in bad, that's what TLT is for. Look for the upcoming data to be let's see how it comes out. All right, and then we'll reassess from then on. I'll keep this video relatively short. I know I say that every time and it ends up being a 20 to 30 minute video in any case, but I definitely have to cut it short because my throat is killing me at this point. Hopefully, even in my sickly state, you enjoyed this video, and if you did, leave a like, subscribe, and I'll see you next time, guys. Bye bye.